Ever heard of a European insurance giant that pays you a steady dividend, generates solid free cash flow, and trades at less than 7 times forward earnings? Meet Aegon Ltd, ticker AEG, a Dutch multinational that might just be the most underrated financial stock on Wall Street. Headquartered in the Netherlands, Aegon operates in life insurance, pensions, and asset management across Europe, the US, and Asia. It boasts a market cap of $11.1 billion, but more interestingly, an enterprise value of $15.1 billion, which shows there's some hidden weight in its debt structure. So let's unpack that. AEG trades at a PE ratio of 17.58, but the forward PE drops to just 6.95. That's a massive discount, suggesting the market expects earnings to rise, or the stock is underpriced. Its price-to-sales ratio is 0.84, and price-to-book is 1.15, both signaling fair to undervalued territory in the financial sector. Even the price-free cash flow sits at a reasonable 13.88, which makes it attractive for value investors. But valuation is only part of the story. With a current ratio of 6.95 and quick ratio of 1.92, Aegon is sitting on strong liquidity. It can easily meet short-term obligations. Still, the debt-to-equity ratio of 0.74 tells us that Aegon is using leverage moderately. But here's the catch. The interest coverage ratio is just 0.83, which raises concerns. It's barely earning enough to cover interest payments. And when it comes to profitability, the numbers are lukewarm. ROE at 7.17% is okay, but nothing spectacular. ROA at just 0.07% and ROIC at 1.25% show that capital efficiency is low. This is typical of traditional insurance businesses, but it also signals slow growth and tight margins. So, what's the income story? So Aegon pulled in $13.29 billion in revenue, with a gross profit of $5.71 billion. Solid margins. Net income came in at $632 million, translating to an EPS of $0.39. It's steady, consistent income. No wild swings, but no rocket ship either. Here's where AEG gets interesting. It generated $801 million in free cash flow, which is 50 cents per share, higher than earnings. This gives it a FCF margin of 6.03%, proving it's cash-rich. But it's not all sunshine. Aegon holds $3.59 billion in cash, while carrying $7.14 billion in total debt. That's a negative net cash position. Now let's talk dividends, the thing income investors love. Aegon pays $0.17 per share annually, which is a 2.4% yield. Not bad in this rate environment. But here's the red flag. The dividend is down over 50% year over year. That could be due to restructuring or a conservative approach, but it's definitely something to watch. Market sentiment? AEG has moved just plus 2.5% over the past year, reflecting investor hesitation. With a beta of 0.88, it's less volatile than the market, a safer pick for defensive portfolios. However, the RSI of 69.69 shows it's nearing overbought territory, so if you're jumping in now, tread carefully. So where does that leave us? Aegon isn't a flashy tech stock or a high-growth machine, but it's a solid, undervalued income play with strong free cash flow and decent financials, if you can stomach a few red flags like dividend cuts and interest coverage issues. For value investors, or those seeking global insurance exposure, AEG deserves a closer look. Do you think AEG is a hidden gem or just a value trap? Let us know in the comments. And if you love deep dive stock analysis like this, hit that like button, subscribe, and ring the bell so you never miss another market insight.